Hey everybody, welcome back to the Optometry Money Podcast. We're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner professional and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and attention today. And today's episode, I'm going to talk a little bit about cash flow. I want to have a conversation on cash flow, specifically within your optometry practice. And I've been fortunate to dive into the financials of practices in working with clients and having conversations with clients about their financials, working together with some phenomenal accountants and tax pros and CFO level experts in optometry practice financials. And we'll review these for a variety of reasons, for projecting out the year for tax purposes, for whether new expenses or new team members should be added to the practice, or whether the owner can afford to distribute more to themselves, or decisions on what to do next with extra cash flow, pay down debt, invest, etc. And throughout the conversations, we're usually talking about the differences between profit as it shows up on the P&L, the profit and loss, versus the actual net cash flow of the practice. What are the actual dollars flowing through and out of the business? And it's this difference between profit and cash flow that I just want to mention and talk a little bit about today and why it's so important. So with that said, let's go ahead and dive in. And within any business, there are three main financial statements. Most of my clients, actually, in fact, all of my clients use QuickBooks Online. And so we'll go into QuickBooks, go to the report section, and you're going to see a whole list of reports, but there are three primary financial statements in any practice. It's going to be the balance sheet, which shows you at a specific point in time, what is the financial health of the business? What are the assets that the business owns? What are the liabilities of the business? And what is the owner's equity of the business? There's the profit and loss, also known as the income statement, and then the statement of cash flows, which also shows you the activity over a period of time. And all of them are important, though the most commonly known statement is the profit and loss or income statement. And understandably so, most owners want to know what they're earning from the business. And the profit and loss shows the revenue, hopefully broken down so you can track different sources of revenue that are important to your practice. It's going to show the different expenses in the business, from cost of goods sold, which is a direct cost to the business for you to provide services. It's going to show non-OD staff, OD compensation if you have associate doctors, your owner's compensation, which should include your wages and employment taxes, benefits attributed to you, occupancy costs, marketing costs, and everything in between. And then subtracting those out, you get the profit or loss, if it's negative, the profit or loss of the business during that time period, showing the economic value that the business created for you, the owner, right? What's left for you as the owner after everything is paid for. But there can be important differences between the profit that's on the P&L, the net income number that's on the P&L, versus the actual cash flow of the business. And some examples are, for example, your accounting method can determine that quite a bit. If you're using an accrual accounting method, you are recognizing or seeing income show up on the profit and loss as you're providing services, meaning as the income is earned instead of when that cash flow comes in. Same thing with expenses, or cash-based accounting, where you're not seeing that show up on your financial statements until the revenue shows up in your bank account, or when you actually pay for expenses or when you swipe that credit card. Most practices are going to be using, from what I see, cash basis accounting simply because it's simpler, it's more straightforward, although some may use accrual. I've heard it argued that accrual can be a more accurate representation of what's going on in the practice, but the accounting method, whether it's accrual basis or cash basis, can determine quite a bit on that front. Another big one is debt payments. If your practice has debt, only the interest portion of those debt payments show up as a deductible business expense on the profit and loss. At least it should. It should only show up there. The principal portion of those payments is not a business expense. You're just paying principal back to the lender. those principal portions show up elsewhere in the financials. So if you're only looking at the P&L, you're going to see a smaller expense for that debt because it's only going to be the interest, but the actual principal portions of that are dollars leaving your bank account. So those aren't going to be accounted for there. You also may see non-cash expenses on the profit and loss, like depreciation or amortization. It's possible with the way depreciation is taken for tax purposes that it doesn't align with the actual cash flow of buying the equipment. So you'll see those expenses which reduce profit, but they're not actual dollars leaving your bank account, leaving the business. Even the use of credit cards can shift the cash flow from one month to the next because you buy the expense and recognize it in 1 month, but the actual cash to pay off the credit card may not happen until the next. So that can cause some differences if you're looking at a really short time period, like month to month or quarter to quarter. So those are some of the most common ones I see. And for both accounting and tax purposes, you might see differences between the two. Depending on how you manage the finances, you can even find yourself in a position where you have a profitable year, but without enough cash to pay the tax next April. So when you're trying to make decisions in the business of when to spend money, how to spend money, when to save it, when to distribute it to yourself, whether you need to increase your wage and what that does to the practice, you'd want to have a better feel for the actual cash flow of the business. Not only what's on the profit and loss, but what dollars are actually coming into your practice and what dollars are actually going out. So where do you find that, right? If it's not a perfect picture on the profit and loss, where do you find that? Well, I like to go to the statement of cash flows. And this is probably the least known financial statement, but the statement of cash flow shows you the actual flow of dollars into and out of your business over a given time period, whether it's 1 month, a whole year, quarterly, rolling 12 months, whatever it is, as well as the categories or sources of that cash flow. And the statement of cash flow breaks down cash flow into 3 sources or categories. And it shows you cash flow from the operations of the business, operating activities, meaning what cash comes in and out of the business from actually doing the stuff of the business, providing optometric care, selling the products that you sell, frames, lenses, things like that. It's actually doing the business stuff. And for those of you using QuickBooks, the way this is put together is that it starts off with your net income, which you would find on the P&L, and it adds back or subtracts non-cash adjustments to get to the actual cash flow from your operations. So how much cash flow is your business creating or losing from doing the actual operations of the business? That's number 1. Number 2 is it'll show you the cash flow from investing activities, which shows you the dollars you spend buying long-term assets of the business, like equipment, or dollars you receive from selling those assets of the business. That type of investment activity in the business is going to show up there. And then lastly, cash flow from financing activities. Financing activities of the business, meaning dollars related to raising capital for the business. So if you borrow money, those dollars that you borrow are going to show up here in the financing activity section as a positive. If you or another owner contributes money into the business, it's going to show up there. On the other hand, if you make loan payments, this is where those principal portions of the loan payments show up in the financing activities of the statement of cash flows. And this is also where distribution to owners show up. So any money to or from lenders or owners is going to show up in this section. So you can see the cash flow story broken down between the operations, your investment in the business, and financing activities to raise dollars or pay back lenders, things like that. So importantly, the statement of cash flow explains the changes in your cash account on the balance sheet. So if you pull up 2 balance sheets, one from one period of time, another from another period of time, there might be differences in the cash. And so you might be wondering, well, why did the cash change? Well, your statement of cash flow is going to describe why exactly the cash changed in that balance sheet in your business. If your cash goes up or down from one period to the next, the statement of cash flows tells you why that happened and where the cash came from or went to. All of these statements are bound together. They're tied in together. And so looking at these categories, you can see the story of the business through cash coming in and out and where it comes from. For example, you can see, did your business have a positive net cash flow in general for the time period you're looking at? Maybe you're looking at it over the course of a year. Hey, what happened over the last 12 months? Did my business provide cash to me? And so you can see if that happened and where exactly that cash is coming from. Is it coming from operations, actually providing services to patients? Is it coming from borrowing or lending? Is it coming from you as an owner adding dollars to the business? Where's that coming from? You can look at, did it have positive operating cash flow? Meaning, are you actually bringing in dollars from the work of the business? And this is really the lifeblood of your business, right? Your ability to provide care to patients and provide products to patients that are going to benefit the health of their eyes and their eyesight. Is this work that you're doing bringing in cash? Is it stuck in accounts receivables? And do you have billing issues? Is too much inventory being purchased and not being sold? Right? Those are things you'd want to dive into. And so, and how does that operating cash flow compare to the operating profit on the profit and loss? In their book, Managing by the Numbers, Chuck Kramer and Ron Risuto have helpful tests to sort of help you review the health of your operating cash flow once you get beyond the cold start phase. Because in those early years, in those early days after cold start, you're just trying to get revenue in and keep expenses paid, right? So most of that cash flow is probably going to come from financing activities, right? That practice loan and the operating cash flow that comes from that. It's not until you get out of that cold start phase and more into the growth phase where you start to see operating profit turn positive and you can start to self-sustain and start to pay yourself an income and even see additional cash flow from there. So once you get beyond that cold start phase, they provide 4, I think, helpful tests to give you some thoughts around, is my operating cash flow specifically relatively healthy? And number 1 is the operating cash flow positive, right? This essentially has to happen. This is the lifeblood of the business. And if you're past that cold start phase and you're not seeing positive operating cash flow, you need to find out why and fast. And number 2, is the operating cash flow greater than net profit? In most cases, it should be greater than the profit on the profit and loss, because that net income, that profit, will often include those non-cash expenses like depreciation and amortization. And so in those cases where you do see those on the profit and loss, you want to know whether that operating income is higher than the net profit, and if not, why? Number 3, is it greater than fixed asset investment? And meaning, are you creating enough cash flow from your operations to cover your investments into assets of the business, to purchasing equipment, to building out a new lane, whatever it may be? Or are you having to rely on financing? And you may use other people's money, and that might be perfectly prudent, right? That might be perfectly prudent. You're essentially just bringing forward future earnings into the current year, and you're planning to get a higher return on those dollars than the interest. So that may perfectly make sense, but I think it's helpful to see, are you even able to fund that with your own operating cash flow? Or are you forced to rely on outside financing? And then number 4, finally, is operating cash flow trending in the same direction as net profit? And I really like this one. So if you look at the last few years, what's the trend? Is your net income and operating cash flow heading in the same direction? If profit's going up while operating cash flow is going down, something's going on. Is that revenue cycle management taking too long to get that cash flow in? Are you buying too much inventory, more than you can sell in a reasonable time frame? And I think those are 4 just kind of helpful things for you to keep in mind as you're looking at your own financials, saying, hey, am I meeting some of these tests? Are there any, is there anything I need to look into? And I think just having a curious mentality as you kind of look through these bits of information is helpful. Ask yourself, why are things happening? Why are things changing? And kind of get to the bottom of it. It helps you to know when adjustments need to be made. It also helps you know when to lean into something because it's working really well. Some other things you'll see from the statement of cash flows. Again, if you purchased assets like equipment, you can see where that money came from. Did you have enough operating cash flow, or did it come from lending? And then importantly, you can see how much money is going to pay back the principal of your debts. And importantly, You as the owner, are you distributing too much, or is there room to distribute more? Are you causing negative cash flow with the amount of debt your practice is taking on, or the amount that you're distributing to yourself as the owner, even when there might be positive net income? So those are some things that you can see as stories that you can learn about as you look through these financial statements. And so when you're making decisions in your business, and this is really the conclusion here, right? When you're making decisions in your business, trying to project out numbers forward, thinking about how to use your dollars, new staff or hiring a new OD or a new lane build out or equipment purchases or distributions to yourself, look not only at your profit and loss, your income statement, which is really important, but also at the other things that take dollars from your business, actual cash flow that don't show up well on the profit and loss. Things like principal payments on debt or planned regular distributions to shareholders, or things that came up unexpectedly that you weren't even aware that you're distributing to yourself, or personal expenses that were being paid for on company credit cards that you weren't really keeping track of. Those are all really important for you to have a better idea of what's really available to you in the practice and what's really available to put to use in the practice if you choose to use it. And then lastly, once you have a better understanding of cash flow, you can start to use a framework for what to do next with your dollars. And there's a lot of ways to think about how to use extra cash flow in the business. There's several frameworks out there. I'm a big fan of frameworks for decision-making like this. I like to keep it simple. And I think one simple framework that I look for in deciding what to do with cash flow once your operating expenses are paid for in the practice is from the book Simple Numbers, Straight Talk, Big Profits by Greg Crabtree. And in the book, Greg talks about this framework where as you look at your numbers, understand that once the regular expenses are paid for, once the regular operating expenses are paid for, there are 4 things that will demand money from your business. And he calls them 4 forces of cash flow. But number 1, taxes. You need to be able to set aside dollars to cover quarterly estimated tax payments if you're making those estimated tax payments. Number 2, debt payments, right? So you need to make sure that you have enough cash in order to cover debt payments or pay down lines of credit, things like that. Number 3, your business itself needs cash, right? So do you have enough cash in the business to create a reasonable cash buffer in the business? Not too much, but also not too little. And I would add to also prepare for upcoming planned investments in the practice, right? If you know you're going to spend some dollars on something coming up, build that into there as well. And then finally, you as the owner is the last thing that's going to demand dollars from the business, meaning once you've tackled these other things, taxes, debt payments, appropriate cash amount, cash buffer in the practice, this is where you know what's available for you to put to use for yourself in some way. Paying down debt, investing, making profit sharing contributions, investing in other things, investing in experiences and time with the family, things like that. That's how you kind of have some confidence that you have cash available to you and you're not going to distribute too much, or you're also not distributing too little, keeping too much cash in the business unnecessarily. And this is something you can do quarterly, right? You don't have to do this every month. You can look at it quarterly and make a decision like that. So I think that's a really great framework. But overall, I think the conclusion here is that as you look at the financials of the business, and I hope you do, keep in mind not only the revenue and expenses that show up on the net profit, but also keep in mind other cash flow items that show up elsewhere in your financials. And one last thing I'll say is that the only possible way that you can look at this and make decisions in the business regarding your cash flow and your finances, or if you have clean, accurate, timely financials, meaning someone is doing the bookkeeping in a timely fashion and accurately in an appropriate manner. And I've seen a lot of books done both by professional bookkeepers that know optometry really well and also DIY. And I would almost broadly generally recommend, please hire a bookkeeper to take that burden off your shoulders. There are some great ones that I know that work only within eye care, within optometry, and do a phenomenal job. And your role as the owner, your skill as owner, your time as owner should not go, in my opinion, into the arranging of these numbers, into doing the actual bookkeeping. Your time as owner is best spent reviewing projecting, analyzing, and decision making. And those are things that are done after the bookkeeping is done. So that's where I think your time is best spent. That's where I think your insights and energy and decisions are best made. But none of this is possible without clean, accurate bookkeeping that's done on a regular basis. So with that in mind, hopefully this conversation was just helpful to help you think more about the sources of cash flow in the business and in making decisions around cash flow in the business. If you have any questions, please reach out to me, podcast@optometrywealth.com. Or if you have other ideas or questions that you want to have on future episodes, please reach out as well. Would love to hear that. And if you are on the way to or already at Vision Expo West in Vegas, hopefully you're having safe travels. I will be there as well this week. So if you're going to be there, hey, let me know. Would love to connect with you, hear your thoughts around the podcast and around other topics and just what you think about this cash flow conversation as a whole. So hopefully we can connect there. We will catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.